You're the owner of a small business, which means you're also the tech guy, and HR, and personal assistant, and head honcho, and intern. You could use another pair of hands, like the experts you'll find at Verizon Small Business Days, April 21st through 27th. Get a free tech check, special deals, and more. Call 1-800-483-4428 or visit verizon.com/smallbusiness to book your appointment. Verizon Business.
Reality radio for a really great future. We're talking real money.
Hello again. Welcome back. I'm Don. That's Tom. This is Talking Real Money, where I bet you can guess what we do. Yes, you're correct. We talk about money.
Yeah.
We talk about the financial things that you do in your life, particularly investing your hard-earned dough, because that's where you tend to make the big mistakes. You can make mistakes, buying a little something, but when you make mistakes investing, it can cost you big time.
Unless it's lumber, who's buying anything? Come on, really.
Somebody's buying lumber? Oh.
By the record numbers, it's
I forgot
huge.
to put my IFB in.
Yeah, no, I mean, lumber prices have, doubled in the last year or something? It's ridiculous. Up and up and up and up.
See, I had no idea. I paid no attention to lumber prices.
You don't buy lumber futures? You don't buy the derivatives on lumber futures and really make some money? Because stocks and bonds are never enough. Why would you just own stocks and bonds when you could buy these other tricky things that are going to make you a lot more money and never lose it for you? I love things like that.
I think I smell a topic coming up. 855-935-TALK is our phone number. 855-935-8255. I want to talk to all of you special people in the audience. You know who you are. You're special.
You're looking at me, but I know I'm not.
Yeah, you're not. But you know who you are. You're special. I want to talk to the couple of rich people who will never claim to actually listen to Talking Real Money out there. You think?
What's your definition of rich, by the way?
Really? 9 figures.
Yeah, okay, that's rich.
Yeah, it's rich. See, there you go. I know there are probably one or two of you who are slumming it here on Talking Real Money.
Yeah.
I want to tell you something. You may think you're special because you got a lot of money, but when it comes to investing, you're just as likely to get ripped off as anybody else, because there are no magical formulas for making more money. And this is what all of you love. You want to make more money, but you want to make it with less risk, right? You know you do. You know who you are.
And it's never been truer than just this week when they shut down the Infinity Q Diversified Alpha Fund, which I know you're all pining to get into. Well, or actually to get out of, I should say.
Yeah, I was going to say, a lot of people were getting into it. What did it get up to? Like
$1.8 billion.
Yeah, almost $2 billion.
Which is still relatively, that's a small fund in the big picture of things. That's not a lot of money. It sounds like a lot of money, but
it does to me. It's more than 9 figures.
Well, it is indeed that. But this was a very special fund, Don. This is not like one of those homogenized, boring index funds that we tell you to go on. This is for the important people. Yeah. This is for the big money.
The big money. The players. The players.
Yeah.
The minimum investment was $100,000.
Yeah.
And
what was the minimum charge, by the way?
Oh, the expense ratio?
Oh, yeah, that thing they charge you every year to manage your money.
And they claim they could give you a high return with low risk and still charge you 2.3% per year. And that's a reduction from their normal fee. They were eating some of their expenses.
That's crazy.
Should have been 2.5%.
This week,
what happened?
Last week, they actually had to stop you from getting your money back. I mean, I don't want to put my money in anything where I can't get it like then, part one.
Well,
I'm
it's
never going to pay 2.3 ever. Right.
It's a
fund.
SEC said you're supposed to be able to price it every day, to price the securities. And they lied, basically. And they just made up what the securities were worth, because what they bought was the kind of stuff nobody should be buying anyway.
When you use the word that's going to bring back 2008, 2009.
Memories.
Our fun times then that almost brought the whole thing down. Derivatives, right? I mean, bets on Bets?
Well, now, wait a minute. Let's go back in time. Let's go back to 2000, 2001. What caused a lot of that? CMOs, collateralized mortgage obligations or derivatives.
Yeah.
2008, collateralized debt obligations or derivatives.
So here's the thing. At the end of the day, we go through everything it owns. The fund has been suspended. What's the right word I'm looking for? You can't get your money out. It's they're holding up your withdrawals. There's no way to get your money. But here's
because
at the end of the day,
they don't know what it's worth.
Yeah, I mean, and the guy who is kind of the chief investment officer is on administrative leave. Probably never see him again. But people bought this because they just did what you wanted to do. They wanted to make money, never lose money, and feel special. And now they found out the hard way. There is no such thing, period, end of tape.
That is an absolute. I just cannot, I can't tell you what's wrong with everything, but I can tell you if it promises that, it's wrong.
Tom and Don are talking real money.
A second opinion could save your life either physically or fiscally. Let one of our Vestory advisors help you save your future at Vestory.com, Vestory.com.
For your real life and real future, Tom and Don are talking real money.
Hi, welcome back to the show. Don here, Tom there. This is Talking Real Money. Glad you could drop in. And remember to listen to the podcast. We put this show online as a podcast, and then we do about 3 others every week that are available on better podcasting services everywhere. And remember to tell friends to listen to, and if you like what you hear, review us. You can review us on Apple Podcasts.
Now you're available
only if you like it.
You're
I'm
on Stanking Benjamins.
I am becoming a regular cast member.
You're on Sound Investing.
I'm becoming a regular cast member on Stacking Benjamins.
What did I say? Talking Benjamins.
You said stanking or something.
Stonking Benjamins.
Stalking Benjamins.
Stalking Benjamins.
855, never mind. We're just going to move along. 855-935-TALK is the number, and Pat has a question. Hi, Pat.
Hi, guys. How you doing?
Good, thanks.
Good.
Yes, we're better now that you've called, Pat.
Oh, okay. Well, I try to help. So I got kind of a windfall. I worked for a company years ago and left them in 2000, and I had a pension with them, and they terminated the pension plan and gave me various options for getting my funds out of it, most of which were bad. But so I chose to roll over this $37,000 into an existing IRA that I have with my credit union. And I guess my limited knowledge of it is that probably that IRA doesn't have a really good return. So at this point, first that money's going into the IRA, and after that, then I want to know, or I want some ideas on what I can do with it once it's in that IRA.
What else is in the IRA, Pat?
I'm sorry?
What else is in the IRA? Do you have more money? You have the 37 plus some other money in the IRA?
No, just like $1,000 in it.
Oh, okay. So it's a small one. So now it's 38,000 instead of 37. And is it just in like a savings account or something?
I'm sorry?
Is it just in a savings?
I honestly have to get with my bank and find out what the composition of that IRA is. I have no idea. I'm assuming there's investment options within that IRA.
Yeah, you don't want to take those, whatever they are. You don't want to take those.
Credit unions are great for borrowing money. Credit unions are great for saving money. Credit unions are not a place to go have your money invested because they have relationships with broker dealers who are sitting in the lobby and are going to sell you a nice product that is going to be expensive, probably underperform, and it's just you're not getting fiduciary advice. So I would not do that. Number 2, if you're going to do this on your own, which it sounds like you're very capable of doing, why not just go to somebody like Vanguard, Fidelity, or Schwab, open an IRA, move the money over there, and then we give you funds free at our website that you could use. How old are you, Pat?
62.
Okay. And
so
do you have any other savings for retirement?
Yeah, I have a 401k at my employer, and the last I heard of that, I was doing 2.5%, which doesn't seem very good. So I know there's options within that 401k is with Fidelity, so I can, shuffle that around as much.
All right, I have an idea for you, Pat. I have a great idea. I've got a plan for you right now. Here's a starting plan. 1, go to talkingrealmoney.com. 2, take our risk quiz. Risk quiz, RISQUIZ. Take that. Then, on the main page there, scroll down, you'll see 3 funds from 3 families. Based on your risk quiz, build a portfolio of those 3 funds with Fidelity at your 401k, and then maybe do the same 3 funds with Fidelity, move your IRA to them. Or,
in other words, you could take the IRA and put it into your 401k
if they have the same funds that we suggest.
No, he could just take the money and roll it into his current retirement plan.
I don't know what funds they have at Fidelity. So if they have the same funds, then yes, make life easier. Okay. It would make life easier.
I guess one thing that's germane to me that I honestly don't know is, in that money is now going into that IRA at my credit union, I can move that without penalty.
Yes.
As long as I don't disperse it.
Correct.
But I can move
even
it
then, you could take it. You could take it out for 60 days and do a rollover, but don't mess with that. That's a pain. Just do direct transfers. Just do direct transfers from one custodian to another.
And again, just to make it very simple, you could take it and put it into your current employer plan. Then you have one retirement account. That's what I was trying to say. It makes it simpler. Again,
I don't know what fund choices your 401k provider makes for you. So if they have the 3 funds that we suggest on our website, which is an international index, a U.S. index, and a bond index, then rolling them all together in your 401 would make sense. Otherwise, get yourself an IRA with Fidelity, use the same funds, and then try to get something similar to those funds in your 401k, Pat.
Thank you, Pat. And by the way, if you're running a credit union, someday we're going to say nice things about you when you fix this.
Credit unions and banks too.
Yeah, I know. It's just
I got to tell you,
want to trust them, but you shouldn't.
If you want people to trust you, bankers, credit unions, get rid of the broker in the bank. You are so far behind the times. And by the way, if you are a credit union or a bank with a 100% fiduciary RIA that charges 1% per year or less and follows the same kind of principles we believe in, we will shout your names from the rooftops here on the show.
Send us a note. We'd love to hear from you.
I just don't believe any exist because you guys think you found a cash cow in getting a piece of the broker's action when in fact you're doing wrong by your customers. Not
your customers, your owners. Remember, if you're in a credit union, you own part of the deal. So it's even worse.
Yeah. So, by the way, if you're in a credit union, you're an owner of your credit union, you should complain. You're a member.
It's way overdue. They should really clean this up.
But it's not just them. Think about it, Tom. It's 403Bs. Their 403Bs are just abhorrent, and many of the problems with 403Bs in schools are directly attributable to the malfeasance of the unions that represent the teachers, who have gotten into bed with the annuity companies that create these horrible non-fiduciary products that just shaft teachers left and right. And hospitals.
And that's probably because teachers make too much money.
Oh, yeah, teachers are so well paid.
Yeah, they're
My
overpaid,
daughter
so
quit teaching because she couldn't live on what they paid teachers. It's pathetic.
That's astounding. That is astounding that she actually, she's kind of teaching, right? She's worked for somebody that
She's working for a company that does tutoring, but,
wow.
But in a different role. But it's really sad what we do to people in the name of just making money. You can make money and do it right. Look at us. We make money by acting as fiduciaries. Yeah, we're not rich, but we're happy. 855-935-TALK. Well, not Tom.
Tom and Don are talking real money.
Tom and I created Vestory to help everyone become a better investor, even those who will never be clients. Let one of our advisors help you start your financial plan or solve a money problem free with no obligation or high-pressure sales pitch at Vestory.com. Vestory.com.
Your guides to a really great financial future. Tom and Don are talking real money.
Once again, our telephone number is 855-935-TALK, 855-935-8255. It's free. It's really easy. And almost anything that is money-oriented is a topic that we can discuss. So give us a call.
Happy to do so.
Happy to do so. You can also send questions in at talkingrealmoney.com that we will answer here or on the podcast, because this episode becomes a podcast on Tuesday. So if you do send in a question, remember, it could be answered on any of the podcasts, so you have to listen in to the podcast. And let's do one of those typed in questions. Hello, guys! And thanks for all you do. I'm 59 years old. My current plan is to retire at 62. I am projecting out the growth of my money. I've been using an expected 4% growth rate in the value. That's pretty conservative.
Yes, that is.
I'm wondering if you guys have historical data that shows what I can likely expect with different allocations of stocks to bonds, like 50-50, 60-40, 70-30, 80-20. Thanks.
Yeah, that's always the question, right? What am I going to make on my money in the future? There's a couple ways to look at this. And our planning software will do it either way. It'll look back and say, here's what you would have made, which I trust more than the other thing they offer, which is here's what you're likely to make. I just looked at returns today. Fascinatingly, if you were in a portfolio 60% in stocks, 40% in bonds, globally diversified, for the last 50 years, you made over 10% per year in that portfolio.
I actually have the numbers right here in front of me.
Yeah. Wasn't it 10.8, I think, or something?
10.8 on a 60-40 portfolio, but the problem...
Well, I give you one problem. The last
bonds.
10 years, you made nowhere near that. Yeah, I mean, but here's the other part of that you always point out. That last 10 years, inflation much, much lower. You only made a little over 6% the last 10 years.
Right.
But inflation was much lower. So there's a trade-off there that people forget about. Planning your numbers into the future, by the way, when we do this, again, we put it in the software, it runs 1,000 possibilities, which I think is probably somewhat accurate. I mean, 1,001 that makes it look bad. It's still a crapshoot. Yeah, it really is. We don't know.
So whatever the number is that we've seen in the past, my rule of thumb is, and I like what you've done. You said 4. It's like,
yeah,
4.
I think that's smart.
Okay, I think you're good with 4.
I'm assuming that's not a real rate of return, though. That's 4 before inflation, but okay.
I'm assuming
you didn't
so.
say that.
But I'll give you the numbers. A 50-50 portfolio over the past 50 years, 10% per year. This is global and U.S. and short intermediate bonds. 60-40, as Tom said, 10.8%. 70-30, 11.7%. As you see, the more you had in equities, the greater your return would have.
I think 100% made over 12, right?
14. 14.
Yeah. So, I would not count on that in the future, personally. I don't count on that. I think you take those numbers, you knock off 3%. I mean, something, because it's, as you point out, bonds. I think the all bond portfolio made over 5, right? Going back to 1970.
6. But that, again, is in large part because from 80? From the 80s, interest rates were so high that bond prices appreciated as interest rates came down. There was a modicum of appreciation in addition to those high returns from the bonds themselves. So you get it. You don't get a great indication. I would say the bond portion of a portfolio, don't expect any more than about 1% in a low inflation environment. And for the stock portion of a portfolio, when bonds are low, it's a relative mix. So 5-6%, maybe.
I'm going to hold you to that. I'm going to come back in 20 years and say I didn't make the 5 or 6.
This is a big, total, absolute. I just want to qualify this by saying, this is absolutely guessing. And anybody who says it's anything other than a guess, even a scientific 1,000-scenario Monte Carlo, anybody who says it's any more than a guess is a bald-faced liar, because no one can know.
I mean, in the piece we talked about earlier, about the super secret magic investment that will make you money and never lose it, that you can't even get your money out of. Someone at the end said, well, the only thing I can really do to make sure I'm not going to run out of money or that I'm going to do all right is spend less. I think that's probably
there
correct.
You go. Oh, and
by
the way,
one part of the equation.
I want to add a little thing to that. If you're saying, hey, I like that 100% equity, 14% return, the worst one-year loss was a loss of 47%, while the 50-50 portfolio, the worst one-year loss was half that.
There you go.
See?
Saved your bacon.
855-935-TALK.
Tom and Don are talking real money.
Want a free copy of my book, Financial Physics? Well, go download it right now at Vestory.com, Vestory.com.
Reality radio for a really great future. We're talking real money.
Need a little help with a little money issue? Give us a little call at 855-935-TALK. 855-935-8255. I'm Don McDonald, Tom Cox over there. We're just hanging out, wanting to help you. We want to help you like Robin Hood helped all of those poor people in Nottingham and Sherwood Forest, helping rob the rich to give to the poor. And then in the 21st century, they flipped it, and they rob from the poor to make themselves rich.
You know, it's a fascinating thing. If you criticize Robinhood, we're talking the investing app.
Oh, we're not talking about Robin Hood and my loyal man, happens? Little John.
You're called elitist. That's always number one, right? Because, and then you're called old, basically, right? Because
I am.
Charlie Munger, he's in the middle of, he's 97. I mean, for those of you who don't know Charlie.
He is legitimately old.
Yeah, he's been around for a while. He's done this for a long time. He works with a guy named, what's the guy's name again? Runs Berkshire Hathaway.
He was in the restaurant business. Buffett. Wasn't he in like a buffet business or something?
Yeah. So he's done all this, and he's gotten into war words with the people at Robinhood, which I find fascinating because he called it, he said Robinhood may call it investing, but that's all
BS.
BS.
You can say BS on the radio. You can't say the other word, but you can say BS.
I'm just giggling because I think so. They immediately call it disappointing and elitist. What he said about the fact that he points out that this what you're doing when you trade stocks like you're playing a video game it's like you said, Don. It's a casino gambling or racetrack betting. It's entertainment. It's not investing.
Yeah, and I love what he went on to say. He said that this was destructive capitalism featuring trading orgies. Whooped up.
I never get invited
by the people who profit from them. Trading orgies. He was fired up, Charlie.
Yeah. Here's the thing, and the other part that we have pointed out on this show many times. Robinhood, yes, they let you trade for free. Robinhood profits greatly by all the trades you place because they get a thing called kickbacks from or thing called order flow. Who actually executes the trade? Anyway, I don't want to get into all this, but they've made a lot of money on all of you buying and selling stocks.
Me, but Robinhood told the Wall Street Journal, quote, Robinhood was created to allow people who don't have access to generational wealth or the resources that come with it to begin investing in the U.S. stock market.
Now, correct me if I'm wrong. I believe you can go to Vanguard, you go to Schwab, whatever, and with
$100,
you have to have like 100. You could buy a share of VT.
Yeah, and then you're actually
no commission.
Then you're actually investing in the U.S. stock market.
You're owning 9,000 stocks then instead of trading GameStop.
And here's what I find most disingenuous about that statement is the fact that they call what they encourage people to do investing. It's investing like blackjack is investing.
Yeah.
It's that kind of investing.
It's like going on a walk and then coming back and having 2 pieces of chocolate cake and saying you're improving your health.
Well, it depends on how long the walk was.
It better be a darn long one. I'm trying to plan my afternoon.
You do like a 2,000 calorie burning walk. What would it be, like a day?
Okay.
That's a full day.
Poor analogy. I'll come up with a better one. Sorry.
I'm sure you
get
will.
the idea.
Yeah.
Charlie, hang in there. Keep at it. Hang in there, brother.
I love it. I absolutely adore it. And it is not investing, and it is not a way to
picking on an old man.
And here's the thing. Before we move along to the callers, 855-935-TALK's the number. Robinhood is truly, this is the thing. What they encourage is no different than a casino or a lottery. They're making a fortune off a flaw that we all possess. We have a flaw in the way our brains are wired where we believe we can actually get rich quickly and regularly with little or no effort on our part.
And be entertained. I mean, there's a lot of noise. There's a lot of color. That's fun.
But the main reason people do it is not for the noise and the color.
No.
It's because they honestly think they're going to get rich trading stocks. And you're not going to do it. Charlie, thanks for speaking up for all of us, even though you are a crotchety old guy like Tom. 855-935-TALK is our number, 855-935-8255. Hey, you call me old all the time. If you can't take it, don't dish it.
Tom and Don are talking real money.
Is your portfolio a mess? You may have a case of hodgepodgeitis, but don't worry, we can help. Just set up a free, no-obligation meeting with a Vestory advisor at Vestory.com. No sales pitch, guaranteed. That's Vestory.com.
For your real life and real future, Tom and Don are talking real money.
Hey there, hi there, ho there. Welcome back to the show. I'm Don, that's Tom. 855-935-TALK is our phone number. We still have time to fit in a couple of you, so get on the line before we go away. And you're going, well, I wanted to call. 855-935-TALK, 855-935-8255. Hey, Josh, thanks for calling. Welcome to the show.
Hey, thanks, guys. Hey, I got need some advice. 52-year-old guy, have a pretty good paying job in the medical field, make about 100 G's a year. Selling a rental house in the Seattle area, and I'm going to have a pile of money to invest. Don't really know what to do with it. I don't really have a 401k or have much of a retirement set aside. I have this rental house. I have my primary residence, and in the next 2 years, I'm going to end up with 2 more houses through my mom willing me her house and my in-laws willing me their house. So it's going to be the rental house sale is going to, I think it's going to sell for about $999,000. I owe $200,000 on it with the first mortgage. That's it. And I'm just kind of wondering, what I can do to not pay a whole ton of money on taxes and kind of invest some of it. What do you think?
Wow. First, I think we really should wait until you actually get it and put it into the pile of money, because we're going to have a new program called Investing by the Foot. So once you can measure that pile, then that's a joke. That's a bad joke.
Yeah.
Taxes, huh? And it's a rental property. Pay the taxes.
There really is no trick.
There's the answer.
Trick other than doing some sort of an exchange where you're getting right back into the business of
running real estate,
home properties.
Or
so if that's what you want to do, then sure.
Yeah, you could trade into some of these trusts. The Delaware, never mind. You don't want to do that. It's just going to be expensive.
No DSTs.
See, here's the deal. Taxes are the after effect of actually doing well. They're not a terrible thing because it's going to be capital gains. It'll be long-term capital gains, so you'll be at a lower bracket. It'll be a lower rate. But it's, you made the money. You got to pay taxes on it eventually. You're never going to get out of paying them altogether. You can only delay it, and you can delay it by doing something you probably don't want to do that probably won't do as well for you long-term. And you're going to be better off investing it, we believe.
And at this point, Josh, you're 52 years old. You're coming into what some might call a windfall. This is a big moment. And you already said have set aside a lot of other money for retirement. I personally think, at this age and in this situation, you should go get some professional help, 100% fiduciary, somebody that sits down and says, here's where you are. You're going to be adding this. You're going to do this, this, and this, and puts together a plan for you prior to you taking the money and trying to invest it out in the wild west of all the possible things you could invest. Because this is a point of inflection. This is a major moment to try to do the right thing with this money you're coming into without messing around with it.
And this is one of the best pieces of advice you may not think so, but this is one of the best pieces of financial advice you're ever going to get. What Tom just told you. We need to convince everyone to put the plan ahead of the investments. Park the money, which is another word we don't like, but put it somewhere where it can earn a little bit of money for a while, and determine what you want this money to do for you, what you need it to do for you, how much risk you can take to get it to do that for you, and how much risk you need to take to get it to do what you need it to do. The plan must precede the portfolio. Ooh,
and we have people on our website. Yeah, I love that. Plan must precede portfolio. So we have people up on our website we trust, right? They're still there.
Other firms? Yeah, absolutely. Yeah. We at TalkingRealMoney.com, we want to make it easy for you to find a good fiduciary advisor. You can find several of them there. There are ways to vet advisors.
How do you find them on the website? I always forget.
I don't know. It's on there somewhere.
You got to click on something. It's pretty easy. TalkingRealMoney.com.
TalkingRealMoney.com / I think it's help.
Yeah, and if you've already
Yes, it is.
done...
It's /help.
Thank you,
yeah.
/help. If you've already done the first part, you know what your asset allocation should be, and you're going to do this on your own, we give you free portfolios at Fidelity, Schwab, and Vanguard. Right there, you can run out and invest properly.
Yep, absolutely. But you get the plan
I hope
first.
That helps.
You got to get the plan. This is too important. It's way too important to take lightly, and that's what most of this silly industry does, is they take your money very lightly. If you walk into a broker's office or an insurance agent's office or a broker in a bank and you say, I've got $700,000 and I need to invest it. Tell me what to do.
Yep.
They will tell you what to do. That is wrong. It's just plain old wrong. It's disingenuous. It is backward. It is wrong, but they will lie to you because they want to make money off of you. Now, of course, everybody in every industry, even in the medical industry, makes money off of other people. But the trick is to do it in a way that is honorable and in your best interest. And that's why we tell you, you must have a plan first. It's critical. You can't get by without it.
I've found a lot of people, by the way, will tell me what you just said. They'll call and say, I just came into X. What should I do with it? And I'll tell them, look, we gotta know this, and this beforehand. And people are disappointed.
Right.
Think, well, no, I just want the solution. Just tell me what box to check, where to move the money. And I tell people, you got to be patient. That's down the road somewhere.
And are you exactly like every other person on the planet? Are your wants, needs, fears identical to every other person on the planet? Because that's what you're asking. That's what you're saying when you ask, what should I do with my money? The assumption is that there is one thing that everybody, no matter what their situation, should be doing with their money, and there's not.
It's not the Affinity whatever fund, Q fund,
that
makes a lot of money and no risk.
One-size-fits-all answer. Now, if you have you got $10,000 in your IRA and you want to figure out how to invest that for the next 30 years, yeah, we can give you a one-size-fits-all kind of answer. But otherwise, way hard. Randy, you're up next. Welcome to Talking Real Money. We've got about 2 minutes.
Hey, Randy, go.
Yeah, I got $64,000 left in Edelman Finances in my 401k, and my wife wants me to roll it over because I'm retiring and take a little bit out and roll it over into something. So my question is like if I went to Les Schwab or someplace else, could I cut that up and take say maybe $5,000 or $10,000 out, pay the taxes on it, and continue.
So you need tires while you're there? So you need to
literally where the rubber meets the road. Really, on this one.
No, okay. Here's the thing: $64,000. Your wife wants you to take some out to do what with?
She just wants to spend it. I don't know what all she wants to spend it on. She says, I want 5,000 to 10,000 of it. So
okay, you know you got to pay taxes on that, right?
Yeah. And, but I mean, I've been married for 32 years, and so I figure that's
you do what you have
the least
to do.
I could do.
All right, that's good.
Yeah.
Fine. What you're going to do is you're going to do you're going to do an IRA rollover. You're going to do an IRA transfer. You're going to set up an IRA with somebody like Schwab, but it would be Charles Schwab, or with Vanguard or Fidelity, whomever. And you're going to want to, again, go back and take our risk quiz to see how much risk you're comfortable taking. And then you're going to allocate that between stocks and bonds, global, diversified.
With using mutual funds, not individual stocks or bonds. We give you the portfolios on the website, talkingrealmoney.com.
Yeah.
Take advantage of all that free, all those goodies they'll give you.
So much free stuff at talkingrealmoney.com, darn it. Go get it.
Tom and Don are talking real money.
Set your course for a great future with a free copy of our 60-page Better Retirement Guidebook at vestory.com, vestory.com.
Your guides to a really great financial future. Tom and Don are talking real money.
Most of the people in this business, when you go to them for a free consultation, they are going to sell you something. They are not going to help you. We know that people need help and don't necessarily always need to hire an investment advisor, a financial fiduciary, which is why Tom and I, since the beginning of time for Vestory, have offered everybody who asks time with one of our advisors to start a plan, to find out what you need to do to get to the next step. And it's a lot more time than you're going to get on the show because you only get like a couple minutes here. So
yeah, and the thing is that's always the starting place. Anybody over the age of 50, anybody who's thinking about retirement, you got to have that plan, and we'll give you the free hour. So go to talkingrealmoney.com and click on contact, or the same thing at vestory.com.
We hope you realize that the information provided on Talking Real Money is for educational and hopefully enjoyable purposes only. Providing personalized financial planning or investing advice takes time, so please consult with a really good fee-only fiduciary investment, tax, or legal advisor. You know a good one. Investing must always involve risk. In other words, you can and probably will lose money at times. Also, as much as you want it, no one can accurately, consistently predict the future. So past performance doesn't tell you a darn thing about what the future will bring. Unlike many other programs that say something similar, Talking Real Money is not trying to get you to buy or sell any financial products or securities. Instead, the program is provided as a public service by Vestory, a fee-only registered investment advisor. Thanks for listening, and please visit talkingrealmoney.com for more information and disclosures. That should keep the lawyers happy.